Imagine waking up in New York City and overnight, the US dollar, the foundation of the global financial system for nearly a century, has collapsed. At first, it seems impossible. The dollar is everywhere, in every savings account, in every mortgage, in every international trade deal. But what if, in an instant, that trust disappeared? What if foreign nations, banks and investors lost faith in the greenback, triggering a crisis that ripples through every corner of the American economy? And more importantly, what would happen to the housing market, that cornerstone of American life and wealth? If the dollar failed, the collapse of the dollar wouldn't just be an abstract financial event, it would be a shockwave that tears through families, neighborhoods and entire cities. And nowhere would that impact be felt more dramatically than in the housing market. Because housing isn't just about walls and roofs, it's about mortgages, credit, investment, and the deep connection between people's sense of security and the stability of money itself. For decades, the United States has enjoyed what economists call exorbitant privilege. The dollar has been the world's reserve currency, trusted by governments, corporations, and individuals across the globe. This status has allowed America to borrow cheaply, print money without losing credibility, and finance its massive economy with a kind of built-in safety net. When there's uncertainty in the world, investors flee to the dollar. When crises hit, the Federal Reserve can step in with bailouts and stimulus backed by global confidence. But what if that safety net vanished? The first thing to understand is that the collapse of the dollar doesn't just mean a weaker currency. We're not talking about a simple decline in exchange rates or some mild inflation. A true collapse would mean a loss of faith, both domestically and internationally, in the very ability of the US government to guarantee the value of its money. That could be triggered by massive debt, runaway inflation, a geopolitical shock, or even a coordinated move by rival nations to dethrone the dollar as the world's reserve. In such a scenario, everyday Americans would immediately feel the impact in prices. Groceries, gas, clothing, all would skyrocket as the purchasing power of the dollar disintegrated. But the housing market would be hit in an even more complicated way. On one hand, people might assume that a weaker dollar would make real estate more attractive, since physical property tends to hold value better than cash. But the reality is far more dangerous. Mortgages are denominated in dollars. Banks lend in dollars. Contracts are based on dollars. If the currency underpinning those agreements collapses, the entire system of housing finance unravels. Lenders would demand higher and higher interest rates to protect themselves from inflation. Adjustable rate mortgages would suddenly become crushingly expensive. Families already stretched thin by bills and debts would find themselves unable to pay. Foreclosures would explode across the country. Meanwhile, international investors, who often buy American real estate as a safe haven, might flee. The luxury condos in Manhattan, the suburban developments in New Jersey, the sprawling estates in California, many of these rely on global money seeking the stability of the US market. But if the dollar loses its anchor role, that foreign capital could vanish overnight. What was once considered a safe asset could become toxic. At the same time, builders and developers would face skyrocketing costs. Construction materials are traded globally, and if the dollar collapses, importing steel, copper and lumber would become unbearably expensive. Projects would grind to a halt. Housing supply, already a major crisis in cities like New York, would be further squeezed, just as millions of Americans are being priced out of their mortgages. The result would be a paradox. Empty developments abandoned mid-construction, while millions are forced out of their homes. But let's zoom in even further to the ordinary homeowner, the family living paycheck to paycheck in Brooklyn, Queens, or the Bronx. The collapse of the dollar means that every dollar they earn is worth less and less. Renters face landlords who demand higher payments to cover their own spiraling costs. Homeowners watch their mortgage payments balloon as interest rates skyrocket. For many, the dream of home ownership, already slipping away in recent decades, would be completely destroyed. The psychological impact cannot be underestimated. In the United States, housing isn't just a necessity, it's the symbol of stability, of middle-class life, of the American dream. When that foundation crumbles, when families can no longer rely on the security of their homes, social unrest follows. And in a city like New York, where millions already struggle with affordability, the collapse of the dollar could unleash anger and desperation on a scale we have never seen before. Now let's consider history. We've had glimpses of what happens when currency collapses, though never on this global scale. In the 1920s, Germany's Weimar Republic saw hyperinflation so extreme that people carried wheelbarrows of cash just to buy bread. In more recent times, countries like Venezuela and Zimbabwe have seen their currencies destroyed, with devastating effects on housing and everyday life. In those cases, property values didn't save families because the broader system of ownership and finance was crumbling right alongside the money. Could the United States, the financial capital of the world, ever find itself in that position? Skeptics will say it's impossible. The dollar is too entrenched, too powerful, too central to the global system. But those same arguments were once made about the British pound, which dominated global finance for centuries before being replaced. No empire, no currency, no system lasts forever. And here's the frightening truth. America's debt is spiraling. Inflation has already shaken confidence. Rival nations like China and Russia are openly calling for alternatives to the dollar. If the world decides to move on, the collapse could come faster than anyone expects. And when it does, the housing market, built on the assumption of stable, trustworthy money, would be ground zero for the crisis. Picture rows of "for sale" signs lining the streets of New Jersey suburbs. Picture empty high-rises in Manhattan, their investors long gone. Picture families forced out of their homes, not by a storm or a fire, but by a financial hurricane. That is what a collapse of the dollar could mean for housing in America. And this is just the beginning, because if the dollar falls, the crisis doesn't stop at housing. It spreads to transportation, healthcare, infrastructure, and every service that relies on stable financing. But the housing market is where Americans would feel it first, most directly and most painfully. If the collapse of the US dollar begins to unravel the housing market, the very first tremors will shake the financial system that supports it, mortgages, banks, and the mechanisms that keep people in their homes. To understand just how fragile this system really is, we need to remember something crucial: the 2008 financial crisis. That collapse was triggered not by a currency failure, but by a housing bubble built on bad loans, reckless speculation, and the illusion that real estate prices could never fall. The result was catastrophic. More than 6 million American households lost their homes, entire neighborhoods were gutted, and banks once thought untouchable collapsed. And yet, as devastating as 2008 was, a dollar collapse would make it look small by comparison. Let's start with mortgages, because they are the lifeblood of the American housing market. More than 60% of U.S. homeowners carry a mortgage, and that means they are deeply tied to the value of the dollar. When you borrow money to buy a home, you're essentially betting that the dollar will hold its value over the decades it takes to repay the loan. Banks lend with that same assumption, packaging mortgages into securities, selling them to investors, and building an entire financial ecosystem around the reliability of U.S. currency. But if the dollar collapses, that trust evaporates. Lenders will panic. Imagine interest rates skyrocketing overnight, not because of a Federal Reserve policy decision, but because banks no longer trust that they'll be repaid in money that holds value. Adjustable rate mortgages would explode in cost, crushing middle-class families. Even fixed-rate loans would become toxic, because while the rate itself might be locked, the bank's ability to fund its operations would be in jeopardy. The result? A tidal wave of defaults. Now cast your mind back to 2008. The crisis then was fueled by subprime mortgages, loans given to people who could not realistically repay them. When the defaults began, the entire system collapsed because those mortgages had been bundled into complex financial instruments that spread the risk across the globe. Suddenly, banks from New York to London to Tokyo were infected with toxic debt, and the world economy nearly fell into a depression. A dollar collapse would magnify those same mechanics 100-fold. In 2008, the problem was that mortgages themselves were risky. In a dollar collapse, the very currency those mortgages are written in becomes the risk. It wouldn't just be subprime borrowers defaulting. It would be middle-class homeowners, small business owners, and even wealthy investors unable to keep pace with spiraling costs. The entire mortgage-backed security market, worth trillions of dollars, would implode. Pension funds, retirement accounts, and institutional investors that rely on those securities would be obliterated. The fallout wouldn't stop there. Remember, in 2008, the government bailed out the banks with massive infusions of cash. But what happens if the dollar itself is failing? Where does the bailout money come from? Printing more dollars would only accelerate the collapse. The Federal Reserve, once the global backstop, would suddenly find itself powerless, trapped in a storm of its own making. Banks would slam the brakes on lending. New mortgages would become almost impossible to obtain, except at astronomical interest rates. First-time homebuyers, already squeezed in today's market, would be completely locked out. Real estate developers would see financing dry up, forcing them to abandon projects. Construction workers, contractors, and suppliers would lose jobs in waves. The unemployment shock would echo across the economy, feeding the crisis further. For those already holding property, the outlook would be grim. Some might assume that real estate would act as a safe haven, a physical asset immune to currency collapse. And while it's true that land and buildings hold intrinsic value, the market around them does not. A house is only worth what someone can pay for it, and if the financial system is broken, the pool of buyers shrinks dramatically. Prices would collapse, not rise, leaving homeowners trapped in negative equity, owing far more on their mortgages than their homes are worth. We've seen this before. In the wake of 2008, millions of Americans found themselves underwater, unable to sell their homes without incurring massive losses. Entire neighborhoods in places like Las Vegas, Phoenix, and parts of Florida turned into ghost towns, with rows of empty houses abandoned by families who could no longer keep up. Now imagine that scenario, not triggered by bad lending, but by the collapse of the dollar itself. The scale would dwarf anything we saw 15 years ago. Investors, both domestic and foreign, would scramble to unload properties. International buyers who have long viewed American real estate as a safe, dollar-denominated store of wealth would flee. Wealthy families from China, the Middle East, and Europe often park their money in Manhattan condos or California estates, precisely because the U.S. market has been stable. But if the dollar loses its anchor role, those safe havens become liabilities. Luxury high-rises could stand empty, their glass towers symbols of a market no longer trusted. Meanwhile, the rental market would spiral into chaos. As landlords face higher costs on their own mortgages, they would pass those costs onto tenants. But renters, facing inflation in food, energy, and transportation, would be unable to keep up. Evictions would soar, homelessness would rise, and cities already grappling with housing crises would see the situation spin out of control. This isn't just about economics, it's about the stability of communities. Housing is the foundation of family life, neighborhood identity, and social cohesion. When people lose their homes, it's not just a financial event. It's a personal catastrophe that ripples outward. Schools lose students, businesses lose customers, and local governments lose tax revenue. Crime rises, health outcomes deteriorate, and trust in institutions erodes. The collapse of the dollar wouldn't just destabilize Wall Street, it would destabilize Main Street. And yet, despite the grim outlook, many would try to adapt. Some families might rush to pay off mortgages quickly, desperate to free themselves from debt tied to a crumbling currency. Others might seek alternative forms of wealth, gold, foreign currencies, even cryptocurrencies, to protect themselves. But the reality is that in a systemic collapse, individual actions can only go so far. The scale of the crisis would overwhelm personal strategies. History gives us a stark warning here. In the Great Depression of the 1930s, home ownership rates collapsed, banks foreclosed on millions of properties, and homelessness soared. Shantytowns known as Hoovervilles sprang up across the country as families who once lived in modest homes were reduced to living in tents and makeshift shelters. That collapse was triggered by a stock market crash and bank failures, not by the loss of confidence in the currency itself. If the dollar were to fail, the depression of the 1930s could look mild by comparison. The lesson from 2008 and from earlier collapses is clear. Housing markets are not invincible. They are deeply tied to the stability of money, credit, and trust. When that foundation erodes, the entire system comes crashing down. The dollar has given America decades of stability, allowing families to build wealth through home ownership. But if that anchor is lost, housing could quickly transform from the dream of security into the nightmare of collapse. When we talk about economic collapse, the conversation often begins with numbers, GDP, debt ratios, interest rates. But what those numbers actually mean plays out in the streets of America's cities. If the dollar fails, the effects won't just be measured in bank accounts or stock charts. They'll be measured in empty storefronts, broken transportation systems, and millions of people struggling to survive in urban landscapes that no longer function. No city embodies this reality more starkly than New York. For decades, New York City has been the epicenter of global finance, real estate, and culture. It's where the dollar's strength has been most visible, from the skyscrapers of Manhattan to the millions of apartments stretching out across the boroughs. But in a collapse scenario, New York wouldn't just be a stage for the crisis, it would be ground zero. Let's begin with housing. In New York, the housing market is already brutally competitive, with sky-high rents and limited supply pushing millions of residents to the edge. A dollar collapse would detonate that fragile balance. For homeowners, the mortgage crisis described earlier would be magnified in New York's dense real estate market. Entire apartment buildings financed on debt could go bankrupt, leaving tenants in limbo. Luxury condos, once purchased by foreign investors as a safe haven for their money, would suddenly lose their luster. What once was considered prime real estate in Manhattan could see buyers vanish overnight, leaving glass towers half empty. On the other end of the spectrum, renters would feel the crisis in ways even more immediate. As landlords struggled to refinance their loans in a collapsing currency environment, they would hike rents to survive. Yet tenants, facing rising prices for food, transportation, and energy, simply wouldn't be able to keep up. The result? Eviction waves across boroughs like the Bronx, Queens, and Brooklyn. Families that once barely managed to pay rent would be pushed onto the streets. Homeless shelters, already overwhelmed, would be flooded with new arrivals. The inequality that defines New York would deepen into a chasm. But the crisis wouldn't stop at housing. New York's intricate web of public services would unravel quickly under the pressure of a failing dollar. City budgets depend on tax revenues, property taxes, income taxes, sales taxes, all of which would collapse as unemployment skyrockets and businesses close. Suddenly, the Metropolitan Transportation Authority, already chronically underfunded, would face financial ruin. Subway systems would degrade, buses would be cut, and maintenance would grind to a halt. For millions of working-class New Yorkers who depend on public transit to survive, the city would literally stop moving. Think about what happens when the trains don't run. Nurses can't get to hospitals, teachers can't reach classrooms, delivery drivers can't transport goods. A city that never sleeps would suddenly find itself paralyzed. Gridlock would choke the streets, and with fuel prices spiking due to the collapse of the dollar, even cars would no longer offer an alternative. The daily rhythms of life, commuting, working, shopping, would disintegrate. Public safety would also collapse under the strain. Police, fire departments, and emergency services rely on steady funding and stable infrastructure. In a crisis, those resources dry up. Crime would surge, not just out of desperation, but because strained law enforcement could no longer keep pace. In neighborhoods already struggling with poverty, the breakdown of public order would become visible almost overnight. The gap between wealthy enclaves, able to hire private security, and working-class districts left to fend for themselves would grow wider than ever. And here lies the darker truth. Inequality would not just deepen, it would become unbearable. In Manhattan, the ultra-wealthy might retreat into fortified high-rises, relying on private reserves of food, foreign assets, and personal security. For them, the collapse would be an inconvenience, not a catastrophe. But in outer boroughs, where paycheck-to-paycheck living is the norm, the collapse of the dollar would mean the collapse of life as they know it. The very fabric of the city, its energy, its diversity, its promise of opportunity, would fracture under the weight of desperation. Now imagine the ripple effects across other U.S. cities. In Los Angeles, where housing affordability is already a crisis, tent cities would expand until they swallow entire neighborhoods. In Chicago, already grappling with fiscal deficits and struggling schools, city services would collapse almost entirely. In Houston, Atlanta, Miami, cities that depend on growth, construction, and credit, the slowdown would bring everything to a grinding halt. And yet, New York remains the bellwether. If the dollar collapses there, the world takes notice. The historical parallels are chilling. During the 1970s, New York fiscal crisis, the city was on the brink of bankruptcy. Police and sanitation workers were laid off, crime soared, and the streets piled up with uncollected garbage. That was a financial crisis tied to mismanagement and debt, but the city survived because the dollar itself remained intact. Now picture a scenario where the currency itself collapses. Instead of a temporary budget shortfall, the city would face systemic ruin. The collapse of services would feed back into the housing market in a vicious cycle. As neighborhoods decline, property values sink further. As property values sink, tax revenue dries up. With no revenue, services collapse even more. Families with means would flee to safer suburbs or even other countries, accelerating the hollowing out of America's cities. Those left behind would face decaying infrastructure, failing schools, and neighborhoods where survival replaces opportunity. But perhaps the most dangerous effect would be psychological. Cities like New York thrive on confidence. Confidence in opportunity, in safety, in the value of hard work. When that confidence is destroyed, the city loses its magic. People stop investing, stop building, stop dreaming, and when millions of people give up on the idea that their city can recover, collapse becomes a self-fulfilling prophecy. Yet history also shows that cities are resilient. After the Great Depression, New York reinvented itself. After the crime waves of the 1970s, it rebounded into a global powerhouse by the 1990s. After the shock of 9/11, it rebuilt. The question is not whether New York and other American cities could eventually recover from a dollar collapse, but how much destruction, pain, and division would occur in the meantime. What we must understand is that in an interconnected urban environment, a dollar collapse doesn't just threaten Wall Street, it threatens every street. It affects the immigrant shop owner in Queens, the single mother in the Bronx, the delivery worker in Brooklyn, the banker in Midtown, and the retiree in Staten Island. When the currency fails, no neighborhood is untouched, and no community escapes unscathed. When the United States sneezes, the world catches a cold. That old saying has been repeated for decades to describe the outsized influence of the American economy. But if the dollar collapses, the world wouldn't just catch a cold, it would be thrust into a fever that few nations are prepared to endure. The US dollar is not just America's currency, it's the backbone of the global financial system. Its collapse would ripple through every continent, every market, every government budget, and every household. Let's start with Europe. For decades, European economies have been deeply tied to the dollar through trade, investment, and finance. Oil and natural gas, the lifeblood of modern economies, are priced in dollars. A sudden collapse would mean contracts, reserves, and balance sheets across Europe would instantly be destabilized. Banks in Germany, France, and the United Kingdom, which hold trillions in dollar-denominated assets, would face catastrophic losses. Central banks, forced to cover collapsing reserves, would scramble to find stability in the euro or gold. But the euro itself, still recovering from years of internal strain and political fractures, may not be strong enough to absorb the shock. The result? A potential double crisis in Europe, a dollar collapse that coincides with renewed doubts about the Eurozone's own durability. Then consider Asia, where China and Japan hold enormous reserves of US Treasury bonds. A collapse in the dollar would wipe out hundreds of billions, even trillions of value overnight. For China, which has tied its export machine to US consumer demand, the crisis would strike at the very heart of its economic model. Factories built to produce goods for the American market would suddenly have no customers. Unemployment would rise, social unrest would grow, and Beijing would be forced into emergency measures to stabilize its society. Japan, heavily reliant on both US markets and dollar reserves, would face a different but equally devastating blow: the collapse of its pension and savings systems, much of which are invested in dollar-denominated assets. The so-called safe bet of holding US government debt would turn into a massive liability overnight. Emerging markets would be hit even harder. Countries across Africa, Latin America, and Southeast Asia often borrow in dollars to fund development projects, infrastructure, and government operations. A collapse of the dollar would trigger defaults across dozens of countries simultaneously. Imagine Brazil unable to pay foreign creditors, Nigeria defaulting on loans tied to its oil industry, or Turkey collapsing under the weight of dollar-denominated debt. The global financial architecture would be thrown into chaos, with ripple effects that dwarf the 1997 Asian financial crisis, or even the 2008 global meltdown. Global trade itself would seize up. Container ships that crisscross the oceans rely on contracts and insurance denominated in dollars. Without a stable currency, goods would sit idle in ports. Supermarkets in Europe might suddenly find their shelves empty of coffee from Brazil or electronics from Asia. Fuel shipments would halt as oil producers demand payment in alternative currencies, perhaps euros, yuan, or even gold. For everyday people, this means rising prices, shortages, and uncertainty. What starts as a financial collapse in Washington and New York quickly becomes a food crisis in Cairo, an energy crisis in Berlin, or a job crisis in Mumbai. Foreign real estate markets, often propped up by US dollar inflows, would also collapse. In cities like London, Vancouver, or Dubai, where American investors and dollar-backed buyers drive up property values, sudden capital flight would deflate bubbles almost overnight. Mansions, condos, and commercial towers once purchased as safe havens for dollar-rich elites would see their value evaporate. This would not only devastate local markets, but also eliminate one of the last pillars of global wealth storage. And what about the global banking system? At its core, banks operate on trust and liquidity. Both are anchored by the dollar, which makes up roughly 60% of global foreign exchange reserves and is used in nearly 90% of international trade transactions. A collapse would create a vacuum no single currency could immediately fill. The euro lacks cohesion, the yuan is too tightly controlled, and gold is limited in supply. Cryptocurrencies, while innovative, remain too volatile to serve as a true global reserve. The result would be a period of brutal instability, where businesses, governments, and individuals simply don't know what money is worth. History offers glimpses of what such chaos might look like. During the 1997 Asian financial crisis, countries like Thailand and Indonesia saw their currencies collapse, their markets implode, and millions thrown into poverty almost overnight. Yet even then, the dollar remained a lifeline. In 2008, during the global financial crisis, panic swept across banks worldwide, but once again the dollar provided stability. Now imagine a scenario where that anchor is gone. Instead of providing safety, the dollar itself becomes the storm. Global politics would also shift dramatically. America's power is not just military, it's monetary. The dollar gives Washington leverage in sanctions, trade deals, and diplomacy. If that tool collapses, so does much of America's geopolitical influence. Nations like China and Russia would seize the opportunity to push their own currencies or alternative systems, creating a fractured world economy. Alliances built on the assumption of dollar strength, NATO, global trade agreements, even the influence of the IMF and World Bank, would come under strain. The world order itself could tilt in ways unseen since the end of World War II. For ordinary people around the globe, this would not just be a story of governments and corporations. It would be the price of groceries doubling overnight in Buenos Aires. It would be factories in Bangladesh shutting down as Western orders vanish. It would be gas lines in European cities, protests in African capitals, and savings accounts evaporating in Asian households. The human cost of a dollar collapse would not be confined to America's borders. It would be shared by billions. And yet, amid the chaos, some nations would adapt faster than others. Countries rich in natural resources could turn to barter or regional trade systems. Nations with strong gold reserves or advanced digital payment systems might weather the storm. But the transition would not be smooth, and the fractures created by the collapse of the dollar would reshape the 21st century world in ways we can barely imagine. The world has relied on the dollar for nearly 8 decades. Its collapse would not just be an economic event, it would be a global earthquake, shaking every nation, every market, every person. The epicenter may be New York, but the aftershocks would be everywhere. When we imagine the collapse of the US dollar, the images that come first are often of chaos. Shuttered banks, crashing stock markets, empty shelves, long lines at gas stations. But history shows us that collapse, while devastating, is rarely the end. More often it is a painful transformation, a turning point where societies either disintegrate or rebuild. So if the dollar were to fail, what comes next for the United States, for New York City, and for the world? The first stage would almost certainly be survival. In the days and weeks after a collapse, people would turn inward. Communities would seek to protect what they have. Neighbors might pool resources, and local networks could emerge as substitutes for vanished institutions. In New York City, this might mean community kitchens replacing supermarkets, or informal barter systems springing up in neighborhoods where cash has lost its meaning. The city, dense and diverse, has always been a place of improvisation, and in a crisis, improvisation becomes survival. But survival alone cannot last. The next stage is adaptation. The US government, no matter how battered, would be forced to introduce an alternative to stabilize society. Some argue this could mean a return to the gold standard, tying money to something tangible and trusted. Others believe a digital dollar, blockchain-based and tightly controlled, could emerge as a solution. Still others imagine a basket of currencies, a new Bretton Woods, where the euro, yuan, and perhaps a North American regional currency share reserve status. Whatever the form, the world cannot function long without a common denominator, and the race to create one would define the next era. For New York, adaptation would mean rethinking its role as the financial capital of the world. Wall Street, stripped of its power as the center of global finance, would have to reinvent itself. Perhaps it would pivot to becoming the hub of digital currencies and decentralized finance. Perhaps it would shift toward innovation in green energy, biotech, or technology, industries less dependent on dollar supremacy. The skyscrapers might remain, but the business conducted inside them would be fundamentally different. The housing market, once inflated by cheap credit and foreign investment, would face an equally radical transformation. In the short term, property values would collapse, leaving millions underwater on their mortgages. Yet over time, this collapse could paradoxically create opportunity. With prices reset, housing might once again become affordable for ordinary people, ending decades of speculation-driven inflation. Entire neighborhoods that once seemed inaccessible could open to working-class families. Of course, this would depend on whether jobs, wages, and stability return, but it shows how collapse, painful though it is, could also be a reset. Globally, the end of dollar dominance would spark fierce competition. China would push harder than ever to internationalize the yuan, while Europe would strengthen the Eurozone's financial architecture. Countries rich in resources, from Saudi Arabia to Brazil, would experiment with commodity-backed currencies. Some nations might leapfrog directly into decentralized systems using cryptocurrencies or regional payment networks to bypass the chaos of failed institutions. In this fractured landscape, winners and losers would emerge. But the age of a single global currency, the era of dollar hegemony, would be over. For ordinary Americans, the question is more personal. How would daily life change? Inflation would linger for years, making imported goods expensive and unreliable. Families might buy fewer foreign products, turning instead to local manufacturing and agriculture. Jobs once shipped overseas could return as companies adapt to a new reality of weaker trade ties. The transition would be rough. Factories don tea appear overnight. But necessity has always been a driver of innovation. Think of the wartime mobilizations of the 1940s, when industries retooled almost instantly to meet a national emergency. A collapse might force a similar pivot, creating a more self-reliant America. Still, we cannot ignore the darker possibilities. A dollar collapse could lead to political unrest, populist movements, and deep polarization. The temptation to find scapegoats, immigrants, foreign powers, political opponents, would be strong. History is filled with examples of financial collapse paving the way for authoritarianism. Whether the US emerges from such a crisis as a democracy, a fractured state, or something entirely new would depend on the resilience of its institutions and the choices of its people. And what about New York itself? A city that has endured blackouts, terrorist attacks, hurricanes, pandemics, and recessions might once again prove its resilience. Out of the ruins of finance, New York could reinvent itself as a cultural, technological, and scientific capital. The collapse of the dollar would be catastrophic, but New York has always thrived not because of money alone, but because of people. The immigrants, the dreamers, the workers, the artists who refuse to give up on the city. In the long arc of history, collapse often paves the way for rebirth. Rome fell, but out of its ruins came the Renaissance. The Great Depression wrecked economies, but it also sparked social safety nets and global cooperation that lasted for decades. Even the 2008 crisis, destructive as it was, accelerated the rise of new industries and redefined technology's role in society. A dollar collapse, while devastating, might similarly force America and the world to rethink how economies are built, how wealth is distributed, and how societies can be more resilient. Imagine a future where the lessons of collapse are taken to heart, where housing is treated not as a speculative asset, but as a human right, where communities invest in local resilience rather than relying on distant, fragile supply chains, where finance is less about opaque derivatives and more about tangible value, where nations cooperate not because they are forced to by a dominant currency, but because they recognize that survival in a fractured world depends on solidarity. Of course, that is only one possibility. The road after collapse could just as easily lead to fragmentation, inequality, and conflict. But the very uncertainty of that road is what makes the question so powerful. The collapse of the dollar would not just be the end of an era, it would be the opening of a new one. And so, we circle back to the original question. What happens if the dollar fails? The answer is both terrifying and hopeful. Terrifying because the collapse would unleash chaos across every corner of the globe. Hopeful because within that chaos lies the potential for transformation, for building something new from the ashes of the old. New York City would suffer, America would stumble, and the world would shake. But collapse is not annihilation. It is a reminder of how fragile our systems are and how much power we have to rebuild them differently. The dollar may be the foundation of the present world order, but even foundations can crumble. What matters then is what we choose to build in their place.